Good afternoon, and welcome to the first quarterly compliance review of the year. I'm Heather Gartside, producer of today's event. Your speakers are Dan Cooperstein, Senior Vice President of Compliance here at Corporate Synergies. He is an arresting attorney with broad experience in employee benefits and labor and employment matters. With him, we have Dot Summers, Senior Compliance Consultant. He works closely with clients to identify areas of noncompliance involving health and welfare plans. Today, they will be discussing COVID-19 relief laws, healthcare executive orders, and vaccine guidance and more. I'd like to bring your attention to the widgets at the bottom of your screen. If you have a question, please click the purple Q&A icon on the left. If we don't get to it today, our experts will reach out to you after the event. At the end of the webinar, you will be able to download your SHRM and HRCI credits from the yellow certificate widget on the right. The slides and today's recording will be emailed to all attendees by tomorrow afternoon. We appreciate your time today. Now, let me turn it over to Dan and Dot.
Thanks, Heather, and I'm so happy to be here with all of you today and my partner in compliance, Dot, to discuss the new COVID-19 relief legislation and more.
Hey, Dan, did you say partner in crime?
Yeah, partner. No, actually, I said partner in compliance. I know. Not half as cool sounding, but yeah, that's okay. That's what we do. So, you know, we'll roll with it.
Never have any fun.
Specifically,
never have any.
Exactly. We can never get to have fun. So what are we talking about today, right? The main focus for today is COVID-19 relief legislation. There were two major laws that came out. One on December 27th of 2020, called the Consolidated Appropriations Act of 2021, or CAA. And then the other big one that came out was much more recently, just on March 11th, and that was the American Rescue Plan. We'll just refer to that as ARP, or the Rescue Plan. But that's commonly referred to as President Biden's COVID relief law because President Biden, laid out the groundwork for that when he introduced that in January. And so we're going to really focus on those two big pieces of legislation and talk about how those are going to be impacting health and welfare plans and insurance in years to come. And we're talking about as well the new, we'll be talking about the new President Biden healthcare executive orders and executive actions, the frozen wellness incentive rules that have made things very confusing when it comes to wellness plans, the new guidance that was issued recently on the outbreak period rules, which were rules that had, allowed to pause certain compliance, they paused certain compliance deadlines. And we'll also be talking about COVID-19 vaccine and testing guidance that's come out recently, as well as some other noteworthy developments and key takeaways. The big thing is really, we're going to start today's conversation really on the CAA, the Consolidated Appropriations Act, and really the main changes that it makes for health and welfare plans, which I think many of you out there probably have heard about, but of course we're going to really dive in a little deeper. The first big thing that happened was that it created special temporary relief for health FSAs and DCAP FSAs. It created a new mental health parity requirement, new service provider compensation disclosure requirements, and new surprise billing and transparency rules. And to kick us off, Dot, maybe you can get us started to talk about the temporary FSA relief and the recent changes that we saw to that.
Sure, sounds good, Dan. Okay, as you stated, the CAA enacted at the end of 2020 included major FSA health and dependent care relief that employers may offer to help address situations for employees who are not able to use health FSA and DCAP funds due to circumstances caused by the pandemic. So specifically on February 18th, the IRS issued clarifications to explain in more detail these temporary health FSA and dependent care relief from the CAA. So there are 5 major components to this, and let's kind of real quickly go through each of these. So the first, carryover of unused health and dependent care FSA funds. So for both the health FSA and dependent care plans, a plan may permit carryovers of the full unused balance from a plan year ending in 2020 into the plan year of 2021, and again from a plan year ending in 2021 into the following plan year of 2022. As we know, health FSAs have had the ability to permit a carryover for many years, but in the past, that carryover was capped in 2020 as well as in 2021 to just $550. So this change now allows the remaining balance, or allows the full balance of unused money to be carried over into the following plan year. Additionally, these rules extend the ability to have a similar carryover for the dependent care plan as well, which previously that was not permitted. Next, these rules extended a grace period for up to 12 months in which to incur expenses permitted in plan years ending in 2020 or 2021. So the IRS previously extended this grace period available for health FSAs and DCAPs last year at the end of the calendar year for 2020. Now the CAA permits an even longer extension of the plan's grace period for up to a maximum of 12 months for the 2020 and 2021 plan years. An employer that didn't have a grace period attached to its 2020 plan can still adopt one retroactively, and an employer is also permitted to change from offering a grace period to now offering a carryover provision, or vice versa. However, a plan is not permitted to have both a grace period and a carryover. So the employer will have to, make that decision. Does it seem, more advantageous to them just to keep the carryover, allow the funds to be carried over, keep the grace period again, or switch among both of those? The next change is the addition of a post-termination health FSA spend down. Similar to the spend out option currently available under the dependent care FSA, a health FSA may now permit employees who cease participation mid-year during the calendar year of 2020 or 2021 to continue to incur and be reimbursed for claims for the remainder of the plan in which their participation ceased. Ceasing participation in the health FSA or DCAP applies to those employees that either terminate employment altogether, or could be allowed for an employee who lost eligibility for those plans due to a change in employment status, but remains employed with the employer. However, what we've seen with our groups is that we anticipate employers using this option more for those employees that terminate employment altogether, as due to the pandemic, many employers lost their jobs unexpectedly and thus had unused balances and were being forced to forfeit that money. So this does give them, individuals who, were surprised by furloughs, the ability to use the unused balances. Next, they added a temporary expansion of an eligible dependent care dependent through age 26. So this 26, I'm so sorry, through age 13. I'm still on the ACA, through age 13. This relief allows employees with children who turned age 13, the previous limiting age, in the 2020 or 2021 plan year to be reimbursed for their expenses from the 2020 plan year balance, including carryover or grace period. The only thing is that in order to take advantage of this provision, the employee must have had an enrollment period for the DCAP with the unused funds on or before January 31st, 2020. And finally, these rules allowed mid-year election changes to be permitted without a change in status. So building on the prior IRS election change relief for 2020, the CAA provides that the cafeteria plan may permit employees to change their health FSA or dependent care health FSA elections during plan years ending in 2021 without experiencing a previously required qualifying event. The election must be on a prospective basis, but the funds can be used for any medical care or dependent care expense respectively incurred during the first plan year that begins on or after January 1st, 2020 through the end of the 2021 plan year. Also, please note that if an employer opts to opt into any of these optional changes or permit any of these exceptions, that an amendment must be adopted through their Section 125 cafeteria plan, the amendments may be retroactive as long as it is adopted no later than the last day of the first calendar year beginning after the end of the plan year in which the amendment is effective. So for an amendment to your 2020 plan year, you would technically have all the way until December 31st of 2021 to make that change. All right, let's discuss some of the key clarifications here, with the carryover. The carryover amounts are not capped in any way unless by employer design, and I'm going to talk about that on the next slide. So full balance, an employee has $2,000 left in their FSA, the employer may permit the employee to carry over that entire balance. The carryover amount also does not reduce the amount that can be elected in the next year. So again, that example, that employee that has $2,000 of unused funds in their FSA account at the end of the 2020 plan year would still be able to carry that over and still elect the full annual premium of $2,750 for the 21 plan year. And then finally, carryovers do not count in subsequent years non-discrimination testing. So, this is a pretty big deal for employers who have issues with passing non-discrimination testing, as if they were required to include all of that carryover amount. This could cause even larger failures and possible more taxation of income for HCEs. All right, let's talk now about some plan design possibilities. Remember that making these permitted plan changes are completely at the employer's discretion. An employer is not required to adopt any of these changes or can choose to adopt some but not others. So here are some things that the employer might consider, in these design changes. They may require that an individual be a participant in the FSA or DCAP in the subsequent year in order to be able to use their carryover. So the employee must make an election, have an annual election along with that carryover. Also require that the employee elect a certain minimum amount in the subsequent year. So meaning that employee couldn't just choose to elect $100 and get their carryover from the previous year. Maybe they would have to, require a $500 participation level. The employer could impose a maximum carryover amount. If someone has $2,000 and $3,000 amount available, maybe the employer's going to put a limit on that and say, nope, even though you might have $2,000 to carry over, we're just going to allow plan participants to carry over $1,000. An employer may also want to limit the carryover period to less than 12 months. Probably most wouldn't, because that would be somewhat difficult to administer. And then finally, an employer may choose to offer the carryover only on the health FSA or the DCAP or vice versa. Again, remember these plan changes are completely flexible and optional to the employer. Also, and then finally, just want to also advise that in addition to making changes to health FSAs and dependent care, they do expand also the relief to allow an employee to change any pre-tax contribution, so elections in medical, dental, and vision as well. We're not really seeing a lot of those changes. I think the FSA and the dependent care accounts are the more important to the employees, because those are, accounts and have funding that, is left there being unused. But it is, possible. But again, employers should consider, reasonable restrictions on the number of sub-changes, just because it becomes, very much administratively burdensome. All right, let's now then just talk about some final key considerations. Should these amendments be adopted? Does an employer want to offer these changes? Well, employers should evaluate the permitted changes and make amendments based on what makes most sense for their organization. We're recommending that employers, take a look at your unused funds, get a report from your vendor, seeing, is it more dependent care accounts or FSA accounts where employees are left with money, make those decisions. How many impacted participants are you? If you have 500 employees participating in your FSA and 10 of them have funds left over, is that really worth, adding these additional changes? The next one is probably the most important, is what are the impacts on an HSA? Because it is important to understand that the impact of the carryover extended grace periods will have an effect on the HSA ability. A carryover of unused funds into a general purpose health FSA will make that individual HSA ineligible, meaning that they will not be permitted to contribute to or have employer contributions into their HSA. So to deal with this, an employer may allow employees wishing to participate in an HSA in the following year to waive the carryover amount, or the employer may automatically convert the balances to an HSA compatible FSA instead. There's some timing considerations as well. Want to really be making those decisions shortly, because we are, we're almost through the first quarter, and you have, individuals could be utilizing those carryover fees. And then finally, you need to ask yourself, will your TPA vendor, your FSA vendor, will they be able to handle these changes? In most cases that we've seen, that the FSA and dependent care vendors are taking the lead in implementing these changes, creating plan amendments, and creating employee communications. But the important thing to remember is that this is the compliance with this falls onto the employers. So it's important to understand that, to make sure you know what your vendors are doing.
Great, thanks, Dot. I agree 100%. Certainly, while I agree that, FSA, DCAT vendors out there are really taking the lead here, these new rules provide employers and plan sponsors with so much flexibility that, I'm sure that there's going to be situations arising where a plan sponsor says, hey, I want to do it exactly like this, and they want to amend their plans to come up with a very administratively difficult process. And while administrative complexity is, now allowed under these new rules, there's, likely to be situations out there where the FSA administrator, TPA, or other vendor of that plan sponsor is just not going to be able to handle the administrative difficulty of that. They may not have the operations in place for that. And so definitely important to have those conversations with your administrators and vendors early if your organization is interested in moving forward with any of these, with any of these optional changes. So that's really helpful. Thanks, Dot, for going through that. Okay, so let's talk now about the mental health parity requirement, the new requirement on mental health parity compliance that's in the CAA. And this is the requirement that plan sponsors produce a special mental health parity compliance analysis to regulators upon request. And I know this has generated a lot of interest and questions out there. While specific regulations and guidance have not been released yet to provide a lot of the detail, the CAA does give us the basics. So, what's required here? Well, basically the CAA is telling us that the group health plans and issuers that cover mental health and substance use disorder benefits and that cover medical and surgical benefits must prepare a comparative analysis of any non-quantitative treatment limitations, or NQTLs, that apply to the plan. And then beginning on February 10th of this year, which is a month ago essentially, insurers and sponsors of self-insured health plans must supply this analysis and other information related to it if requested by federal and state regulators, including the U.S. Department of Labor. So first of all, what are NQTLs, right? Just to give some background here, right? NQTLs are technically defined as any limitations on the scope and duration of benefits that are not expressed numerically. So examples could include medical management standards that limit or exclude coverage based on medical necessity, prior authorization requirements, methods used to determine provider reimbursement rates, things like that. And under the applicable mental health parity rules, the processes, strategies, evidentiary standards, and other factors that are used to define plan terms and administer NQTLs for mental health and substance abuse benefits, they must be comparable to and applied no more stringently than the ones used for medical and surgical benefits. So that's basically showing essentially what what the general mental health parity laws do is make sure that the mental health and substance use benefits are as equal as possible to the non-mental health medical surgical benefits. And so what has to really be in this analysis? Well, here's a listing here on the slide of the 5 components of it. But in most cases, and for most sponsors of self-insured plans that are working with an insurance carrier, the insurance carrier already has this analysis completed because several state laws have already required that this be submitted to those state departments of insurance. And so as a plan sponsor of a self-insured plan, before you go down this path, right, starting from scratch here and producing all of this information yourself, right, it would really make a lot of sense to first reach out to your carrier or TPA to see if a copy of this document has already been produced, if it already exists, right? And if so, if they could provide you with a copy in case it's ever requested by a government agency as a result of the CAA. So we're not going to go into all of these details here. And also in most cases, right, there would only be, most employers and plan sponsors with self-insured plans are essentially following the rules on this. They're not making major changes to, subtract out mental health benefits and doing a lot of sort of narrowly tailored decisions on that. So in most cases, you're already going to be in compliance and you're going to have this information readily available. So here's some additional information about this. We already talked about the fact that it only applies to self-insured plans. Carriers will handle for the fully insured plans. Any of these agencies, DOL, HHS, IRS, and even state regulators could request a copy of this analysis under the CAA. And it must be available upon request by February 10th of this year. And if the agency finds that the plan is non-compliant, they will give you a 45-day cure period, fortunately. Also, like I said before, we're still waiting to get some future details on this from future regulations or guidance. But, in the interim, definitely reach out to your carrier. If you have a self-insured plan, reach out to your carrier or TPA to see if they have this set up already and see how they are going to be handling and preparing for this. Okay, let's talk about the new broker consultant and service provider fee disclosure rules that are also in CAA. This was something that really affects everyone in our industry as brokers and consultants, which is what we do. But it doesn't really go into effect until the end of the year, December 27th of 2021. And so just like the other mental health parity rules, we're still waiting for more detailed regulations and guidance to really break down exactly what's required here. But here's the overview of what's in the CAA and what's required. So basically any service provider of a plan that's providing brokering or consulting services, which are both broadly defined and could arguably even include TPAs and other types of service providers that maybe just be providing things like maybe wellness services, things like that, are required to make disclosures received of $1,000 or more in total annual direct or indirect compensation. And so, this could be a very big group of different service providers that may be required to provide fee disclosures. It covers group health plans, including standalone dental and vision, health FSAs, EAPs, and HRAs. And this is a requirement. So the CAA amended a section of ERISA. It made this a requirement of ERISA section 408B2, which for those of you out there with retirement plans, you may be familiar with that section of ERISA. That's a section that requires retirement plan brokers to give a disclosure, to the plan fiduciary, and that will be the same way that this will work. The onus will really be on the plan fiduciaries of the plans to collect these fee disclosures from their different service providers to their health plans when this goes into effect at the end of the year. Also, it has to be provided at each new renewal, so it's reasonably in advance of the renewal. So it's not just a sort of one-time hit. It's every time you renew, these service providers will have to provide that information. And like I said before, we're still waiting for more information from regulations and guidance. And once we get that, we're probably going to go into a lot more detail on those rules in a later webinar. So let's talk about this No Surprises Act component of the CAA. So within the CAA was this other law called the No Surprises Act, which adds new surprise billing and transparency rules to the CAA and to health plans. And this is just a picture of the Radiohead No Surprises cover album. No Surprises is probably one of my favorite songs. For some reason, it always plays in my head every time I read, information about this law. So I just have to pay homage here to Radiohead for a great song. But let's dive in a little bit here. But again, like the other two things we talked about with the CAA, we don't have any regs or guidance really on this, so that we just have sort of a big picture understanding of how this is going to work, and our understanding is that more information is going to be coming out. These new rules on surprise billing and healthcare transparency only go into effect for plan years beginning on or after January 1st of 2022. And what this is, and I know we've talked about this in prior webinars, so I'll just kind of go briefly through. These are rules designed to protect consumers and participants on plans from certain surprise medical bills that they get from out-of-network care and treatment. Generally speaking, that's a situation where you go to you have an emergency, you go to the emergency room, and different workers, different medical providers are working on you. Then you get back home, maybe weeks later, you get a huge bill, an astronomical bill, and you found out only after the fact that you had out-of-network people working on you, essentially, and it's a big surprise. So this law is designed to eliminate that problem by providing all kinds of additional notice and exclusions and limitations on out-of-network care. And then for those situations where that can't be resolved through those other procedures, it provides for an independent dispute resolution process, which is essentially an arbitration process between the plan and the out-of-network provider to resolve the payment disputes. And in addition to these provisions, there's also several new healthcare transparency requirements that are added on to those final healthcare transparency rules that we got at the end of last year. But our understanding is that for the most part, the insurance carriers will be implementing a lot of those rules, and there is not that much really, at least as of now that we know, for plan sponsors and employers to do here. So that's the big picture overview of that. Okay, so let's talk now about the big thing that happened, right? March 11th, the American Rescue Plan, or President Biden's big relief package, which made several significant key changes to health and welfare plans. The big picture thing here: $1.9 trillion in relief, just an astronomical amount of money. Very generous COBRA premium subsidies, 100%. I think obviously they're paying for the whole thing. 100% of the COBRA premium will be paid for from April through September of 2021. The dependent care FSA maximum will increase for the 2021 tax year from $5,000 to $10,500. And there will also be increased subsidies for ACA exchange coverage and an extension of the FFCRA paid leave tax credits. So for employers who are voluntarily offering that paid leave. So a lot is in here. And Dot, why don't you get us started and kick us off with talking about the COBRA subsidies?
Sure, sounds good. As Dan said, very generous subsidies here, 100%. The original bill had an 85% subsidy, which they did increase to 100%. So, these provide relief as a tax-free subsidy that will pay 100% of the COBRA continuation premium for individuals who are or could have been eligible for COBRA for the time period from April 1st through September 30th of 2021. In order to receive the subsidy, the individual must be receiving an offer of COBRA as a result of an involuntary termination of employment or involuntary reduction in hours. Premium assistance is not available to COBRA qualified beneficiaries who voluntarily terminated their employment or reduced their hours, or who experience any of the other COBRA qualifying events such as divorce, death, or loss of dependency status. This is simply a payment subsidy. There is no extension to the normal COBRA period, 18 or 36 months. So if you were eligible for COBRA, but your 18 months has now since expired, this is not an additional 6 months for you. An individual ceases to be eligible for the premium assistance on the date the individual becomes eligible for Medicare or another group health plan coverage, other coverage than an accepted benefit or like an FSA. So, they would have to be enrolled in a group medical plan. This is actually a change from the general COBRA rules, which had this same kind of ineligibility due to when an employee becomes enrolled in other coverage, not just eligible for coverage. So in this situation, it's, when an employee becomes eligible for other plan. They now have a new job and that employer is going to be offering them coverage. But, how does that happen? How does the former employer who is offering this 100% COBRA subsidy, be made aware of their eligibility for other coverage? Well, it is the individual's responsibility to notify the plan administrator if they do become eligible for other coverage, and there is a penalty for those who fail. They would be required to pay a penalty of up to $250, increased for cases of fraud for each such failure, subject to an exception for reasonable cause. Certainly notice requirements, so employers and plan sponsors must notify the employees about these subsidies. So the DOL is required to issue model notices within 30 to 45 days, depending on the specific notice, from enactment of the ARP. Plan administrators, or most likely your COBRA vendors, must not modify and distribute these notices for several different situations. So first, a notice must be sent to individuals who become eligible for COBRA during this premium assistance period, that April 1st through September 30th, and notify them of the availability of this premium assistance. Plan administrators must also notify assistance eligible employees who became entitled to COBRA before April of 2021, and to individuals entitled to a special second election enrollment. And I'm going to talk about that on the next slide. This special election period, this notice must be provided within 60 days of April 1st, 2021. And then finally, plan administrators must send notice to premium assistance individuals where their subsidies will soon expire. So, closer to the 9/30 date, this notice must be provided no more than 45 days, but no less than 15 days before the premium assistance will expire. Okay, so let's now talk about that even more generous subsidy and this special second election opportunity. So, the law does include this opportunity for eligible individuals who do not currently have a COBRA election in effect on April 1st because they declined an original offer, or an eligible individual who previously elected COBRA but is no longer enrolled as of April 1st. So, for example, because they stopped paying the applicable premium, presumably because it was too expensive. The special election period effectively reaches back to qualified events that happened before the ARP's enactment, and allows affected individuals to make a COBRA election for coverage on a prospective basis and take advantage of the subsidy if they are still eligible for COBRA during that subsidy period of April 1st through September 30th. So for an example, this potentially could apply to employees who lost health coverage in the fall of 2019. That is, the 18-month COBRA period would be could be ending on April 30th, 2021. That individual with their original offer of COBRA back in 2019 may be eligible for the subsidy maybe just for 1 month in April. And additionally, plan administrators must provide notice of the subsidy and special election rights within 60 days of April 1st. And then finally, who's paying for all of this? I think this is probably the most important piece to employers is, now employers are kind of, having to take on all of this COBRA premium if they're not charging the employees anything. But the ARP provides that employers will receive a credit for the COBRA premium subsidy through a payroll tax credit against the employer's quarterly taxes. So this is similar to the FFCRA paid leave credits. If the credit exceeds the amount of the payroll taxes due, the credit will be refundable when the employee submits its quarterly federal tax return through IRS Form 941. We're looking for additional guidance on how the credit will work, and particularly as it relates to both insured plans and multi-employer plans. So, great, lot of great information we have, but we also still have a lot of pending information, notices, how the credits are going to work, and all of that.
Great, thanks, Dot. So let's talk now about another big part of the American Rescue Plan that's going to impact health and welfare plans, and that's the American Rescue Plan's ability to rescue people from the ACA subsidy cliff. And how does it do that, right? Or what does that mean? And what does that mean for your health plans, right? That's the big question, right? So first of all, what happens is that the ARP is substantially increasing subsidies, premium tax credits on ACA exchanges for a much broader range of individuals. It's expected, the CBO and others have estimated that it could be as many as 7.5 million more people are going to be enrolling on ACA exchange plans as a result of these much more favorable, premium tax credit rules that basically say that the cost of the coverage cannot exceed 8.5% of your income. There's also cost-sharing subsidies for the unemployed, which are very generous. And then, so with that, and the big thing, of course, here is that it's going to be ending the subsidy cliff. The subsidy cliff, it refers to those who are making above 400% of the federal poverty level, which is equal to approximately $51,000, a little bit above that. And what that means is basically that in the past, because people could only get premium tax credits if they were in between 100 to 400% of the federal poverty level, those people who just made a little bit above the 400% had to pay a much higher amount for their coverage. And that was referred to as the subsidy cliff. And here are some examples. This is a chart that was created by the Kaiser Family Foundation to show how much savings those individuals will be making who are going to be rescued from the subsidy cliff. In this case, there's examples of a 60-year-old, a 40-year-old, and a 27-year-old enrollee with making $55,000 in income, which is 430% of the poverty level. And you can see the substantial amount of savings here. And this was based on the House proposal language. So it says House proposal, but those orange numbers is basically what they're paying. It's the same as the House proposal. So those orange numbers are what they're going to be paying under the American Rescue Plan compared to what they were going to be paying under those blue numbers, which was the law prior to the American Rescue Plan. You can see there's very, very big savings there. In some cases, it's over $500 a month. And what does that really mean? Actually, let's go back to this for a second. What does that really mean for you as an employer and a plan sponsor? You might be thinking, well, so what? So there's just a whole bunch more people going on the exchanges. Well, if you remember from our many prior webinars, if you've ever attended them or other trainings we've done, right, we always talk about the fact that we've talked a lot about the ACA employer shared responsibility rules or the employer mandate or pay or play rules. Those rules, in order for an employer to get a tax penalty under that employer mandate part of the ACA, there's a necessary catalyst that has to happen first, which is that at least one full-time employee has to qualify for and receive a premium tax credit on an exchange. And so what could end up happening here is if your plan isn't offering coverage that meets those minimum ACA requirements, including the affordability requirement and other requirements, then it's possible that you could be seeing a much bigger amount of people that are much larger number of people, I should say, who are qualifying for and receiving the premium tax credits on the exchanges, and potentially, showing that, potentially exposing your organization to much bigger liability if it hasn't been offering affordable coverage that meets those minimum standards. So definitely it's something to be much more careful about now than in prior years. And I know sometimes it can be just a routine part of what you do for your job to, a routine part of your life to always be analyzing that affordability every year. And, you may not have realized, but because of this right now, it's a much bigger priority. So it's definitely something to check up on. The other thing that the American Rescue Plan does, right, is that it's extending these paid leave tax credits through September of 2021. And just as some background on these, originally under the FFCRA, employers with less than 500 employees were required, it was mandatory, to offer certain paid family and medical leave and paid sick leave to employees through December 31st of 2020. And then subsequently, the CARES Act amended the FFCRA to allow for employers to voluntarily offer the paid leave and still obtain a tax credit for that through March 31st of 2021. And then more recently, the CAA now has extended that to September of 2021 and made some other changes to that to make it a little bit easier to get that tax credit. So it's a very generous program here. Now let's talk about, okay, so that's it for the American Rescue Plan, and let's move on to another big thing that happened that we've received a lot of questions on, which was the healthcare executive orders and executive actions by the Biden administration when President Biden took office. And really the big thing here was that, one of the major changes was he, first of all, made changes to ACA exchange coverage special enrollment. So he opened up an enrollment period from February 15th through May 15th so that during the pandemic, more people could get coverage on the ACA exchanges. And then a very big thing for employers out there and plan sponsors is that he reversed several Trump administration executive orders on healthcare policy. And while signing these, he said, I am restoring the ACA back to what it was before the Trump administration. So it was very clear what he was doing and what the goal here was. And one of those Trump-era executive orders that was rescinded was the one making it easier for employers to engage in association health plans, short-term limited disability insurance, and ICHRAs, or individual coverage HRAs. So, major change there. So while those rules, for example, ICHRAs, you could still technically sign up for an ICHRA, and you could, there still are going to be association health plans for some time now. But those rules may be changing. So we would say if you're looking at getting into any of those things, you may want to exercise caution on those. President Biden also reversed policies on reproductive health care policy of the Trump administration, as well as rules regarding benefits for LGBTQ participants. One of the big things that he did was saying that we're going to be directing the agencies to follow the law of in the Supreme Court, the June 2020 case of Bostock, where it was held that employers cannot discriminate against individuals on the basis of sexual orientation or gender identity with respect to employment and employee benefits as well. And so while that doesn't change the law in any way, it will make sure that the agencies put back into the rules a lot of those protections for LGBTQ participants. And while the big takeaway there is that there's nothing that you as an employer and plan sponsor have to do to change your plan as a result. One question that we received is, do we have to offer gender transition surgery or other gender transition related services under our health plan as a result of that? The answer is no. I mean, the main thing, of course, is just to be careful to not be making changes to any of those benefits that might constitute discrimination against individuals on the basis of sexual orientation or gender identity, and that's the main takeaway there. Also, the Biden administration did a regulatory freeze when it came into office, freezing rules on wellness incentives under ADA and GINA, which we'll talk about in just a minute on the next slide. And then also it froze rules on ICHRAs and how they apply with regard to the employer mandate, and final rules on worker status. These are rules designed to make it easier to tell if someone is an employee versus an independent contractor. And while those are really more labor and employment laws, they can have an impact on benefits in that, if you have, independent contractors working at your organization, you might not have to offer them benefits. And, the Biden administration really saw those things as sort of an end run around, the traditional employee benefits rules and labor and employment rules. And so those rules were frozen as well. Okay. So, a lot happened, right, with freezing these rules when the Biden administration came on. And first of all, just briefly here, this picture is not the frozen wellness that I'm actually talking about for this slide, but I thought that my kid's YouTube yoga instructor deserved a picture in one of our slides, given all the hard work that she has done to keep my kids physically active and engaged during this pandemic. So this one's for you, YouTube yoga instructor lady. Thank you. Thank you so much. Okay. So let's talk a little bit about wellness incentives. The real frozen wellness incentives, that is, right? What we're actually talking about today, which is that as background, at the very end of the Trump administration, the EEOC issued proposed ADA and GINA rules on wellness incentives. That was on January 7th of 2021. and then final regulations came out shortly thereafter that were issued but not actually published in the Federal Register, which means that they were technically not 100% final yet, and they could have been paused or frozen by the Biden administration. And just briefly to explain what happened there, those wellness rules were issued in order to fill the void that was left by a set of earlier rules that the EEOC had withdrawn in 2018 in response to a court order. And these January, Trump administration rules generally allowed employers to offer employees wellness incentives under plans subject to ADA and GINA, but only if they were de minimis incentives. And the rules did not give a very specific definition of what was meant by de minimis. And so traditionally, de minimis means a value that's not very substantial or practically close to nothing. For example, like a water bottle, a pencil, maybe a T-shirt for participating in a wellness program. And of course, most employers' wellness plans out there that are subject to the ADA and GINA are offering a lot more than that. So these January rules were causing a lot of concern for employers and employer industry groups, and who began to immediately request that the EEOC clarify what was meant by de minimis. And also, this was particularly important for these employers in light of the fact that many of them wanted to incentivize employees to take COVID-19 vaccinations, and these types of incentives would likely be considered to be wellness incentives that would be subject to the requirements of ADA and GINA, right? So this ultimately created a lot of issues, and but of course, so what happened next, right? So the proposed rules were frozen since they were never fully finalized. When the Biden administration took office on January 20th of 2021, it immediately froze those rules. That is, it put them on pause, subject to revision or potential withdrawal upon their review. And that was on February 12th of 2021, when that was officially. Then on February 12th of 2021, the EEOC officially formally withdrew those Trump-era wellness incentive rules. And of course, that leaves us in something of a difficult area because, and while we'll talk more about vaccination incentive programs shortly, right, the key takeaway here is that while these regulations remain frozen, in the absence of any clear guidelines on wellness incentives, right, we don't really know what to do, right, if your plan is subject to ADA and GINA. So what we would recommend is that you strongly recommend, we recommend that you strongly be very, very cautious here and exercise caution and make sure that you don't go overboard with any wellness incentives by offering very rich incentives that may be seen by employees and regulators as being coercive and coercing employees into doing a particular health activity under your wellness plans. And we'll talk more about that with regard to vaccination programs in just a little bit. So Dot, do you want to talk about the new take on the new guidance on the outbreak period rules?
Sure. So just as a quick review, all of us have heard of this term outbreak rule. Back in May of 2020, the agencies issued guidance which provided relief for certain deadlines for plan participants due to COVID-19 pandemic. So some of those examples are the 60-day period to elect COBRA, the 30-day grace period to make a COBRA premium payment, 30-day period for HIPAA special enrollment rights, things like that. So this outbreak period, in determining the due dates for any of these actions, employee benefit plans were required to disregard an outbreak period when determining the due date. So in essence, plans have been required to stop counting such time during the outbreak period. And that outbreak period was to begin on March 1st of 2020. So, but this outbreak period was to be offered for a limited period of time. I don't think any of the agencies or any of the lawmakers ever thought we would, honestly, or anybody would ever think till a year later we would still be in this national emergency. So the outbreak period, this limited period of time, was explained in the guidance to end on the earlier of 60 days following the announced end of the national emergency, which we know is still going on, or per certain ERISA rules, a period of up to 1 year that may be disregarded. So although the national emergency continues, questions were raised in February of this year regarding the end of the outbreak period. This is because the guidance did not clarify how that 1 year limit would be applied. Since the outbreak period, again, started on March 1st, 2020, many believe that it would end February 28th, 2021, even though the president has not declared an end to the national emergency because, it's the lesser of 1 year for the end of the national emergency. So, we're through that year. And if it ended February 28th of 2021, plans could resume counting on March 1st to determine the due dates of any of those actions that have been paused or affected by the outbreak period. But then on February 26th, just a few days before most people thought the outbreak period was going to end, additional guidance was issued to clarify exactly how this 1-year limitation did apply to the outbreak period. And unfortunately, much to the dislike of many plans, the agencies did not apply the 1-year limitation to the outbreak period itself, meaning an overall end date of February 28, 21. Instead, the DOL indicated that the 1-year limitation is applied to individual periods affected by the outbreak period, and that an individual's effective period ends the earlier of 1 year from the date that specific individual was first eligible for relief, or 60 days after the announced end of the national emergency. So how do we figure out this end date? So, pretty much basically, we first need to identify the original due date of the deadline of the individual action and basically add 1 year. So let's look at a couple of examples on the next slide to kind of illustrate, how these periods are, again, calculated. So we have 3 examples here, and let's look at Sarah. So Sarah is an employee who had a COBRA election period that started on February 1st. So we know February 1st of 2020. So normally Sarah would have a 60-day election period. But because the outbreak period or the pause period began on March 1st of 2020, that is 29 days into her 60-day election period, 31 days remain. So now her election period, that 60 days, is now paused. The clock has stopped ticking. Sarah's 1-year pause period ends on February 28th, 2021, 1 year from the start of the outbreak period of March 1, 2020. So what that means is that her election period again begins to run on 3/1 of 2021. Sarah now has the balance of her original 60-day COBRA election period, or 31 days, to elect COBRA. So now she basically has a deadline until March 31st of 2021. Next example, Megan. Megan's COBRA election period started right as the outbreak period was starting. So her pause period begins on 3/1/20. So basically her clock never started. Her 1-year pause period ends on February 28th, 2021, and at that time, her election period to elect COBRA starts to begin to run again. Now Megan has 60 days to elect COBRA with her deadline of 4/29/21. But let's now look at a situation where somebody COBRA or their deadline is way past the start of the outbreak period on March 1st of 20. So now here we have Sophie, who has a COBRA election period starting on 4/1 of 2021. Her pause period, again, similar to Megan, starts immediately because the outbreak period is in effect. Her 1-year period ends on March 31st, 2022, and her election period begins to run again on April 1st of 2022. So Sophie has an entire year from her original election date to start to run and to elect COBRA. Now, the one thing to clarify with Sophie, she does get that year a pause period, but only as long as the national emergency is continuing. So, technically, if we were unfortunate, I even hate to say this, that the pandemic would be continuing through May of next year, Sophie would still have that additional year. If, let's say, the pandemic ends on August of 2021, Sophie would have her 60-day election starting at the end of the national emergency. All right, Dan, do you want to end us here with the vaccine? Yep. After the end.
Yeah, definitely. Yeah. So that's an important point that Dot was making at the end there, right? Is that, all of these examples on this slide are just meant to show you how easy it is to calculate by adding 1 year. But technically, right, we're assuming, and let's just hope this doesn't happen, right? But we're assuming that the national emergency is continuing through May 30th of 2022, but yeah, obviously if the national emergency period ends earlier, then you just take that plus that 60-day time period, and that would be the earlier period of time that would apply. But this is really helpful. Thanks for going through those, Dot. Great. So let's talk a little bit about vaccine guidance, and we're going to kind of go through this briefly. This is really not, this is really more for your own benefit here. This timeline, which just shows you how many big developments happened here, really since December of 2020. One of the biggest things that happened for employers was on December 16th when the EEOC released guidance on employer vaccination programs, which allowed employers to mandate that employees take the COVID-19 vaccine, and so long as there were reasonable exceptions for individuals with sincerely held religious beliefs and individuals with disabilities. So as long as you had accommodations for those individuals with disabilities and sincerely held religious beliefs, you could technically mandate that your employees take the COVID-19 vaccine. And of course, that was the big picture from the employment standpoint. But then later we got, at the end of February, much more specific rules on vaccines with regard to health plans, or what health insurance plans can and can't do on vaccines. And one of the really interesting things about this guidance was that, basically all of the, I think there are things that we basically knew on the vaccines, basically, right? That the vaccines have to be provided without cost sharing. And they, all 8 kits recommended vaccines, which are the big 3 that everyone's heard of, right, have to be covered without cost sharing and be included in the SBC, the Summary of Benefits and Coverage. So that stuff wasn't that big of a change. But one thing in here was very interesting, which is that there were rules about COVID-19 testing that greatly expanded when insurers have to cover the cost of the COVID-19 test with no cost sharing. And it's basically for almost any circumstance, with the exception of employment-related screenings, return to work testing, and testing done for safety or public health surveillance. The guidance says that, generally speaking, as long as it's a diagnostic test approved by a medical provider, a doctor, it will be covered without cost sharing, regardless of whether the person shows symptoms or the person could be completely asymptomatic. Basically, any type of circumstances, as long as the doctor approved it, it has to be provided without cost sharing. So definitely, if we've heard some reports out there of plans that are not, they're still charging for that COVID-19 testing. So you definitely want to share the new guidance on that with them. So we talked a little bit about this earlier with wellness incentives, but the big thing with vaccination programs is that, right, you have to have, there's 3 main types of vaccination programs out there we're seeing employers do, right? The mandatory vaccination programs where every employee has to get this done, and if they don't, there will be implications. Of course, there have to be exceptions for, like I said before, sincerely held religious beliefs and disabilities. And then a lot of employers are doing what are called incentivized or encouraged vaccination programs, where they're providing some kind of employee benefit to the employees to incentivize them to take the vaccination. But like we said before, right, there are employee benefit laws that come into effect there, right? The wellness rules under ADA and GINA, which we currently do not know how much you can offer as an incentive for, as well as rules under HIPAA and ERISA group health plan rules. So there's a lot of things to take into account if you're considering doing an incentivized program, and definitely you should speak to your corporate synergies benefits consultant if that's something that you are interested in doing. And like the mandatory programs, the incentivized programs also have to have carve-outs for individuals with sincerely held religious beliefs or accommodations for individuals with disabilities. And then, of course, you could also offer a voluntary vaccination program, and we have some pros and cons of that. The main, of course, risk being, of course, that there could be exposures, right, in your workplace if you don't do anything at all. And, of course, as we wrap up here, those vaccination slides, the pros and cons, are really for your own benefit. We're not going to go through all of those today, but we just want to let you know there's a lot of things happening right now, obviously, as the president appoints key employee benefits positions, as new rules come out, as the new Johnson & Johnson vaccine was approved. There was also a big settlement against Blue Cross Blue Shield, which a lot of our clients have asked us about, and we can provide additional information on that as well. But basically, a lot of things are happening right now in the news. So we would definitely recommend that you check out some of our resources online, which are on the next slide. But some of the key takeaways today, really are that, talk to your FSA administrators, right? Talk to your COBRA administrators, talk to your TPAs, right? Make sure they understand how the new COVID-19 relief legislation works, how the new outbreak period rules work, and then of course also look, at your organization and determine if any of these, this relief will work for your organization, and also balance those pros and cons of implementing a COVID-19 vaccination program if that's something you would like to do, and we'll have those slides on there on this presentation as a resource for you, and of course. Get ready to comply with all of the many new other provisions that are coming out as a result of all this new legislation and COVID-19 relief. So here are those online resources we would definitely recommend that you check out where you can learn more. The Compliance Resource Center, our social media health and welfare compliance or HAWK forum, as well as here's a link to our future events. So thank you so much for joining us today, and we look forward to doing more of these presentations in the future. Thank you.
Thanks so much.